Hello everyone and welcome to your Glassnode Week on-chain video report for week 26. I'm your host Checkmate and we're recording today on the 29th of June 2021. So last week the Bitcoin market really defended that $29,000 to $30,000 price floor, with price having now bounced up to around $34,000 at the time of recording. And what's quite impressive about last week is it actually absorbed a number of elements of sell-side pressure. The first being the second largest capitulation in dollar-denominated terms in all history. And we've also seen a migration of hash power out of China, and that's going to have an impact on whether miners actually have to liquidate some of their treasuries. It's going to have impacts on overall revenue now that prices have declined from the previous all-time high. So there's a number of elements here in terms of the sell-side pressure that the Bitcoin market is essentially trying to absorb that excess supply. And that's really a focus of what we're going to look at today. So we'll have a look at what the breakdown of this capitulation event was, how much of it was short versus long-term holders. We'll have a look at the overall mining market and what the revenue is telling us, what the overall supply balances are telling us. And then we'll also close on the institutional demand. We'll have a look at some of the institutional products like the GBTC, the ETF products that are out there, and also just a bit of an overview of the Coinbase balance, which gives us an insight into what was otherwise a major supply sink for Bitcoin during Q1 2021. So here we are in Glassnode Studio. We're looking at our week on-chain dashboard. And really the headline moment of this week in terms of price action was Bitcoin breaking down to 28,900, which is the local low. And during this period of time, we saw an enormous amount of realized losses on chain. So let's start by discussing this, what we're calling a capitulation event, which is actually the second in this recent consolidation. We can see here in our net realized profit and loss that we've had a first major capitulation in mid-May, and this one here has actually eclipsed it in terms of total dollar-denominated size. And what we mean when we say a realized loss or a realized profit is for all of the coins as they move around on chain, the UTXOs are created and destroyed, we can assess what price that UTXO was created at, and then we can also assess what price it was destroyed at, or when that coin was spent. And by looking at the delta between both the time and the overall price difference between the UTXO creation and UTXO destruction, we can establish whether that coin was moved at a profit or at a loss. And that's what we term a realized profit or a realized loss. Now, this left-hand chart is essentially netting out our realized losses and our realized profits together and looking at what was the overall net outcome. And what we saw during this week was a net loss of around $3.45 billion, which is the largest in history. And what we do need to just take into account is that as the Bitcoin valuation will grow, as prices get larger, it is just possible to realize larger profits and larger losses in absolute terms. Now, what's quite interesting about this particular event, and if we compare both of these two capitulation events that we've seen, we've got here our realized loss and our realized profit, which is really splitting up that net into both of its components. And we can actually see that the net losses, or the total losses realized on chain, were actually larger during the May sell-off. And what that's really telling us is that our realized profit, which has continued to break down, is suggesting that those who are holding profitable coins are actually spending them less and less and less. So even though the overall net losses were less, the overall total losses were less during this capitulation event, they have not been offset to the same extent by the overall profits. And what that's telling us is the people that have those profitable coins are just not interested in selling down at these prices. And that is in fact a sign of signal of strength. And it's telling us something about the dynamics of the market, that even though price was threatening to head lower, we actually didn't see the same number of people exiting and taking their remaining profits. People who are concerned that their unrealized gains may start to evaporate. They're essentially sitting tight at this point. So that was quite an interesting and encouraging in terms of finding levels of support. Now, if we now jump across to our SOPR, which is our spent output profit ratio metrics, we've got three of them on display here. The first one is our adjusted SOPR. And what this really represents is, whereas the previous charts were looking at absolute dollar value of how many dollars were realized profit loss, what the SOPR does is it essentially corrects for, within that particular day, what's the overall profit ratio? Are we seeing more coins moving at a profit? What's the magnitude of profit or loss being realized? So it's a bit more of a relative scale. And what we can use these for, there's a few different models. We've got our adjusted SOPR, which is a market-wide. It looks at the entire cross-section of the market. whilst it does exclude transactions that are younger than 1 hour, which generally represent relay transactions and they're not economically meaningful. They're normally a hop between the final destination. So we filter out transactions that are younger than 1 hour, and we're just looking at what is the magnitude of profit realized by those other economically meaningful coins. So it represents a market-wide view, and what's important to note is that we've really been oscillating around this value of 1, which is indicating when it's below 1, there's realizing losses, above it's realizing profits, and really the market is trying to jostle around and build this foundation of consolidation. There's a few people who are uncertain, buying the dip, selling the top, selling the rallies. So there's a lot of gyration around this value of 1, but on the whole, it's existing below a value of 1, suggesting that overall losses are being realized by the market as a overall net value. So that's really aligning with what we're seeing in our net realized profit and loss. You can see fairly similar market structure in terms of both of these metrics. They really are capturing a fairly similar concept, which is on a relative basis, how much profit and loss is being realized on a particular day. Now, what we can then do is break it down into our long-term holders, which are coins that are roughly older than about 5 months. So people who've held their coins for an extended period of time and statistically are less likely to re-spend them during volatility. And the others is our short-term holders, which essentially represents the other side of that equation, people who've accumulated their coins in the last 5 months and are therefore more likely to re-spend them in the coming weeks. Now, what's important here is with our short-term holder SOPA, it's maintained a value below 1 for almost the entirety since mid-May. And what this is basically showing is that everybody who has purchased their coins largely up here in this top zone, up in the $55,000, $50,000 range, they're essentially the majority of the transactions that are going on. All of those coins that are on the move are essentially realizing losses. And ultimately, this is where we're getting the majority of our capitulation potential from. We noted that our realized profit is relatively low. And given that roughly 5 months ago, which is our threshold for short and long-term holders, price was actually in and around a very, very similar level. We were back here in mid-January, and what that's really telling us is that almost all long-term holders, people who've held their coins for that lengthy period of time, almost all of them are actually in profit. So we've kind of got this interesting dynamic where any losses that are being realized are disproportionately represented by short-term holders, and conversely, those that are older than that 5-month period are disproportionately holding profitable coins. So we have this interesting bifurcation of the market where we can actually look at profit and loss almost as cohorts of long and short-term holders. So on the short term, almost everybody who's moving their coins is realizing losses. And what was interesting about this week is whilst we didn't have that much profit that was realized, so not many long-term holders spent their coins, we did get quite a lot of gyration, oscillation, some bit more volatility in the long-term holder SOPA. Now, the way that I generally interpret long-term holder SOPA is more of a profit multiple. You'll note that most of our other SOPA ratios tend to oscillate around a value of 1. You can see here on the axis, between 0.9 and 1.1 is fairly typical. And this generally represents that overall, if you net out all of the coins that are on the move, they're moving at plus or minus 10% of when they were previously spent. Now, conversely, with long-term holder SOPA, we know that overall Bitcoin tends to go on these fairly lengthy bull markets and then fairly lengthy bear markets. And what that generally means is that the profit multiple that's realized, you can see here the numbers are much higher than 1. 1, 2, 4, 6, 8. These are representing 400%, 800%, 600% type of realized profits. So by holding the Bitcoins for longer periods of time, there's more participation in the exponential upside that we've seen historically. So when we see these larger oscillations or larger volatility in long-term holder SOPA, we can almost back that out and say, well, what kind of cost basis are people selling their coins at? So when you have a higher long-term holder SOPA, it means that they're spending cheaper coins that may have been purchased at the $6,000 level, the $3,000 level, and they're realizing larger profit multiples. Conversely, when we have a lower instance of long-term holder SOPA, which we had this week, we saw long-term SOPA broke down. Let's actually zoom in. Let's go to our 3-month chart. You can see that we had a breakdown during the recent capitulation event. And that's suggesting that there was a smaller amount of profit that was realized And that's suggesting that coins that may have been purchased at 15,000, 16,000, slightly closer to the price, and potentially signaling that some of those long-term holders may have actually been spooked by that sell-off. So that's really how we can interpret it. There was a little bit more volatility in this long-term holder SOPA, and that suggests a bit more of a range in the overall cost basis. Some people were selling their coins at $6,000, some people were selling them from $16,000, and that overall uncertainty is then reflected in a long-term holder SOPA. But it is important to note that they still remain a minority portion of who was actually spending. So disproportionately, this capitulation event was largely driven by short-term holders, and we can really see this by the difference between our net, which was essentially the largest net realized loss, comparing it to our realized losses from the overall market, which are actually the second highest. So it gives us an idea that there just really wasn't that much profit that was realized at all. And to add a little bit more flavor to that, if we look at our lifespan metrics, so I've got here our average spent output lifespan, ASOL, our average coin dormancy, and our coin days destroyed. So these are all metrics that look at the total age of coins that are on the move. And for the ASOL, for example, it's looking on a per UTXO basis. So for all of the transactions that were occurring, how old were the UTXOs? It doesn't care about coin volume, it just cares about the age of the UTXO. Dormancy takes the volume of coins that are moving and it essentially adjusts for the average age per unit BTC. And our coin days destroyed is more just the total value of lifespan. How many coin days that were accumulated by the spent coins were destroyed on that particular day. So the way that we interpret these metrics, higher values essentially indicate that we've got older coins that are being spent as a relative proportion of the overall coin movements. So when we have a fairly sustained downtrend, and if you actually look over the period of this consolidation, our dormancy has broken down quite substantially. Our average spent output lifespan is also breaking down, particularly during the last couple of days. And our coin days destroyed is in a fairly structural downtrend, with this week being no exception. And what that's really telling us is that overall, a lot of these older coins are remaining dormant. They're just not being spent. And that really supports what we're seeing on our total realized profit. It's telling us that those older coins that are by and large in profit are just not being spent. And that's telling us that there is that conviction that remains within the market. And it's something to just be paying attention to. And should we actually get a reversion of any of these metrics, let's say that we get a relief rally or another sell-off to the downside, and a number of these old lifespan type metrics really start to rallying and start moving into a sustained uptrend, that's really indicating that that conviction is starting to wane, and some of these older coins are coming back onto the market, whether to take exit liquidity or just out of sheer loss of conviction. So that's a bearish indicator that we would otherwise be looking for, is if we get a break up of any of these particular metrics. What we would like to see for sustained price action is really these to continue to trend down, which is telling us that older coins remaining dormant. And we would like to see our SOPA metrics really start to trend higher, suggesting that there is profit being realized, but the market is able to absorb that supply that's coming back onto the market. So that's really what we'd like to see, SOPA start to break higher and sustain that trend. And for a more bearish trend, we really don't want to be seeing dormancy, coin days destroyed, and ASOL breaking and sustaining an uptrend. So what we also have going on in the market is one of the largest migrations of Bitcoin hash rate in history. We're seeing a major movement of hardware outside of China. Almost overnight, we've seen an extraordinary amount of ASICs being turned off and moving into logistics and being shipped elsewhere in the world. We're about to experience the largest downwards difficulty adjustment of about 25% is estimated. And what this really does is at the moment, any miners that remain on the network are currently mining at the previous difficulty. So we're seeing blocks coming in somewhere on the order of 23 minutes on average. So more than double what the target block time is. And this is then going to prompt the protocol to wind down the difficulty to make the puzzle slightly easier for those miners. Now, for the miners that remain on the network, we have essentially, when the difficulty is winding down, their profitability is going to go up because they're spending the same amount of dollars on their current hashing power, but the overall amount of coin is being distributed amongst fewer of those miners. So per hash, their revenue is actually going to spike higher. So any miners that remain on the network are going to be getting an outsized share of the overall revenue. Now, the converse side to that is balanced by the miners who are currently in the process of shipping their equipment. They're now exposed to logistical risk, to expenses. They're obviously not generating any profits because their machines are currently in transit. or being liquidated. So we have this interesting balance where the miners that remain on the network are actually going to be able to generate more revenue and therefore sell fewer coins to cover their costs. It's actually going to be quite profitable for them over the next coming weeks. Whereas the miners who are currently switched off are essentially incurring enormous costs. And some of those miners may have to liquidate parts of their treasury. And really what we're looking at here is what does that balance between revenue stream and necessary selling pressure to cover logistics, how do those two really balance each other? So let's start our analysis. We'll look at our balance in miner wallets. Now, what this is essentially showing is if we have a sustained uptrend like we did through 2019 and most of 2020, what this is essentially showing is that overall, miners are still distributing some of their coins to cover their compulsory expenses, but they are able to build their balance. They're essentially using some of that cheaper offset power relative to the market price. They're able to accumulate coins at a cheaper price with power, sell less of them, and therefore they can build up their treasury reserves and essentially participate in the overall upside as the bull market starts to come into effect. Now, we saw a fairly substantial liquidation from a number of miners during the 2021 Q1 sell-off, essentially selling those coins into market strength. So we saw a fairly substantial downtrend there. And over time, as we moved into this $50,000, $60,000 range, it started to form somewhat of a base. And then from about mid-March, we started to build and return back into this uptrend, suggesting that those miners were then again reaccumulating coins. And in terms of overall gradient, relatively similar to what we had through 2020, and roughly representing something on order of about 7% or 8% of the coins that they were mining, they were maintaining within their treasury. Now, if we zoom into the last 3 months, what we did see, so here we are following our May sell-off, we did in fact start to see some early signs that this was about a drop of 7,000 coins in overall miner balance. We've maintained a somewhat flat uptrend, but overall we can see that the total selling side pressure of this, or the overall liquidation of these miner balances, it started to step in. And maybe some of this was a liquidation of a treasury in preempting some of the news that was coming out, or those who were more savvy and aware of it. So we've started to see this liquidation of those treasuries. And this is during a period of time where the Bitcoin price is more or less depressed. So what this is telling us is twofold. One, we could potentially see more of these down dips as some of those miner balances are liquidated to cover those expenses. But simultaneously, we're essentially trading in a largely range-bound sideways trading range during that same process. So what we're seeing is the liquidation of those coins is more or less being absorbed by the market at the current price level. Now, again, should this continue to change and we get more and more coins flowing out from miners, then it really comes to test whether the market can absorb those coins, and that gives us a signal of the overall demand side of the equation. Now, if we look at our total transfer volume from miners to exchanges, through most of 2020 and early 2021, it was averaging somewhere in the order of about 400 to 600 coins per day, and bearing in mind that they're mining something in the order of 900 coins a day on average. So selling somewhere between half to 2/3 of their overall inflows. Interestingly, since we started to peak up here in the $50,000, $60,000 range, we've actually seen a fairly substantial structural downtrend in the overall flows from miners to exchanges. So as of the current period, we're talking about somewhere in the order of about 200 BTC per day. So it's starting to reflect that overall balance between some of the miners are going to remain profitability. Some of them are going to be in the process of logistics and moving their hardware, and whether they have to liquidate their entire treasuries or not will very much depend on the overall dynamics of hardware supply and total costs incurred and all of the other components that's involved in such a monumental move of hash power. So really, this is another metric that we can pay attention to and keep track of, just to understand whether we start to get a significant upflow in overall miners sending coins to exchanges. How does that start to change the overall dynamics, and do we overall see the market absorb those coins, or does that provide too much sell side pressure? So there are a number of different metrics that we can pay attention to here just to understand the overall balance of this dynamic for miners, noting that some of them are going to actually become more profitable whilst others are incurring fairly substantial costs. And finally, we can look at our balance on OTC desks. So miners being relatively large bulk size sellers, compulsory sellers, OTC desks are a favored venue for matching with larger buyers. Now, what we generally would like to see for bullish price action looking at our OTC desk balance is a sustained downtrend, or in this instance, a sideways trend would also suggest that matching of buyers and sellers. And we can actually see that through Q1 2021, and then even as we moved into this sell-off, we've more or less had three different zones, call them step changes in the overall balance on OTC desks. And you can see that it's oscillated up and down as buyers are matched with sellers. You get inflows, which then are matched with outflows. So we've seen these general step changes. So during the first part of Q1 or back end of 2020 and into Q1, we had this overall view up here about 10,000 to 12,000 coins. Following the first peak at 42,000, we actually saw a fairly substantial outflow. So we moved down to this 8,000 to 10,000 range, which we oscillated around until around April. We then had another step change down where we've now moved into the somewhere between 8 to 6,000 coin range. Now we can see that there's a number of spikes in our OTC desk balance, which by and large have actually been absorbed by the market. And actually during the last couple of weeks, we've seen another significant outflow from overall OTC desks. So what this is really telling us is that despite the fact that we are likely seeing minor inflows, we are seeing selling pressure coming in, and it is very possible that we could very well see more of that selling going on depending on the dynamics of the migration. What we're also seeing is that on the OTC desk that we are tracking, we can see a general matching between those buyers and sellers. So it's really supporting that sideways consolidation market, that it's a reaccumulation phase at this point in time. And really what remains is what happens from here on. Are we going to see that continued matching of buyers and sellers? Will we start to see more inflows as miners liquidate their treasuries? And will the demand side remain strong enough to actually absorb whatever coins are coming in? So on the mining front, this is giving us a bit of an idea on what we can expect. And it's going to be very interesting to observe this balance between miners liquidating treasuries and miners whose profitability will actually spike due to reduced competition on the network. So finally, let's move on and have a look at our institutional demand flows. So we're going to look at a number of metrics here. We're going to look at the Grayscale premium, or in this case, it's a Grayscale discount. Our balance on exchange for Coinbase, which ultimately has been one of the preferred venues for many US institutions, and our two BTC ETF products, the QBTC product and the Purpose Bitcoin ETF. So we'll start our analysis by looking at the Grayscale premium, or the GBTC product, which since Q1 2021 was trading at a premium somewhere between 2% all the way up to over 20%. And since about mid-February, we started to progress into this perpetual downtrend. So a lot of the arbitrage opportunity that traders were capturing when it was a premium in Q1 has essentially transitioned into a discount as we have more and more of those shares becoming unlocked, coming in as supply, and we do not have the demand coming in during this period to really absorb that unlocked supply. So it progressed into an increasingly low discount, hitting a maximum low of minus 21.3%. And since that point, which is just before the sell-off in May, we've actually started to see a minor reversal. So we've seen about a 10% increase in the overall discount. So that's bringing it from a minus 20% up to somewhere around the minus 10% at the low end. Over the course of this week, it traded from about minus 14% to about minus 4.5%. So we're starting to see that discount closing up. So what would be good to see is this discount either maintain these higher levels, where it's essentially creating much closer to the net asset value. What we don't really want to see in a more bearish instance is if we actually see this discount continue to trend lower, which is again showing that there's not enough demand to soak up those GBTC shares, and essentially that as more and more of those shares become unlocked, that trade really needs to find more and more buyers to come in and keep that discount at a reasonable level. So this will give us a bit of some early sign that perhaps there's demand coming in on the institutional side, but really what we're looking for is a sustained trend in this particular discount, and ideally closing up that discount to a smaller level and then maintaining it. Now on the ETF front, we have two ETF funds, the QBTC and the Purpose Bitcoin ETF. On the QBTC front, we've actually seen an outflow of over 10,000 coins over the last month and a half. So it's a fairly substantial drawdown in total holdings on the QBTC fund. Whereas on the Purpose Bitcoin ETF fund, we've actually seen an increase of just under 4,000 coins over the last month and a half. So even following the sell-off in May, we've still seen a gradual increase, which has actually accelerated over the last couple of weeks. And overall, if we actually map this out on a per 7-day basis, it's roughly around 95.8 BTC inflows per day. So we have a bit of a mismatch here where the QBTC is seeing outflows of around 10,000 coins. The Purpose ETF has seen an inflow of somewhere on the order of about 4,000 coins. If we actually net these out, there's about a 6,000 coin outflow overall between the two. So we're still seeing a net outflow from these ETF products. And really what we'd be looking to see is a continuation of this purpose ETF flow, and ideally a reversal of the QBTC. And obviously there's going to be differences between these two products that may be driving this difference. And finally, we look at the balance on Coinbase, which has been the preferred venue for many US institutions for accumulation. We can see that there was around just over 1 million coins on the balance in late 2020. And then we saw a very, very significant outflow. So this is institutional scale outflows from Coinbase, which really carried on all the way through to about mid-May. Following the sell-off, we've really seen a quietening down of that. So it's still a gradual downtrend. But from the million coins that we had in 2020, down to around 735,000 coins. So again, a very significant outflow through most of Q1 and into Q2. What we've really seen is a slowdown of this pattern. So in a more bearish trend, we would actually see this start to reverse or maintain a period of being very flat, showing that we're not seeing that institutional demand flowing in and really absorbing those coins out of the Coinbase exchange. And simultaneously, if we get a resumption of this downtrend, particularly at the scale and size that we saw in Q1 and early Q2, then perhaps that signals the converse of that we're actually seeing a reinvigoration at these lower prices of more institutional demand. So thanks for tuning in. Hopefully that gave you a bit of a walkthrough and a bit more detail into the Week on Chain newsletter this week, and I certainly look forward to seeing you in the next one. Cheers.